What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is September 19th of 2019. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to focus in on a very key topic that I think is extremely relevant for you all to understand. Many of you have already been asking me about it over the last 24 to 48 hours, as it's been buzzing all around in the media. In today's video, I'm going to be talking about what the Federal Reserve did when it injected $75 billion into what's known as the repo market. Now, for those of you who might be a little bit overwhelmed by this topic, don't worry. I'm going to break it down in very simple terms and keep it very practical so you get an idea of what's really going on. And I'm also going to provide a non-biased view on this topic. Again, I think a lot of people are quick to jump the gun to choose their side on what this really is, whether it's a non-issue or an issue. And I want to try to provide a very balanced view on this and really look at the facts. And in fact, I actually recorded this last night at around, well, technically it was early in the morning at 12:20 a.m. But this is a recording I did last night, so we'll segue into it in just a moment, as I was just really eager to talk about it and it was really fresh in my mind. Outside of that, though, as well, towards the end of the video, we do have a sponsored review for Blackmoon, so I really recommend that you guys stick around for that. But let's go ahead and dive into the video. All right, so it starts off here with this big spike in the repo rate, or the rate to borrow capital in the repo market. So a lot of people are curious about what this means, and then also what the repo market is in general. Well, I want to go ahead and point you all to some awesome resources. What really prompted me to do this video is a tweet storm put out by Heidi and Moore, who really summarized what's going on quite well, and I think she provides an interesting perspective. But I want to start off from ground zero here, right? I'll put all the links down below in the description so you guys can do your own research. Let's go ahead, though, and understand what the repurchase agreement or repo market is. So a lot of people have a misconception that banks predominantly just simply lend out to consumers. You would probably think about lending in the sense of short-term money, in the sense of credit to go out and buy goods and services, car loans, home mortgages, student loans, small business loans, right? It's very common, and that is a big business practice by banks. It's usually where they hope to make money in the long term. But there's also a very large market that's not talked about much and not known by many people, and that is the repo market, where banks actually are lending to one another. They're providing capital to one another for short-term necessities, and usually it tends to be that the bank has to borrow money from another commercial bank, i.e. maybe JP Morgan borrowing money from Goldman Sachs, in order to satisfy their reserve ratio, basically making sure they have enough money in order to lend a specific amount of credit to people like you. Now, this is what banks have to commonly do. That's usually the reason they do it, but there can be all kinds of various reasons for this, as we'll kind of allude to later on in the video. But this is a very common thing that happens in the background every single day. Banks are exchanging hundreds of millions, if not billions of dollars between one another through this system. And what they're actually doing, and we'll go ahead and do a quick example here, is it's not as risky as it sounds. It's not JP Morgan giving $20 billion over to Goldman Sachs and just simply saying, hey, hope you pay me back plus interest. In this case, it's the repo rate, but they are coming in with a form of collateral of some sort. So when JP Morgan is lending money out to Goldman Sachs, in our example, JP Morgan is getting, in exchange for giving out $20 billion to Goldman Sachs, they are getting in return a variety of high-tier securities. And this tends to be usually treasuries or tier 1 equities in this case, high-scale companies, again, to give incentive for Goldman Sachs to pay back JP Morgan, because if they are insolvent, they don't pay back the loan in this case, they've got the underlying assets, the collateral that they can utilize to cover on the loss of not getting their loan paid back. So this market is very interdependent on trust. It's dependent on the idea that banks are going to borrow money from one another and pay them back plus the interest rate, right? There's the money you can make from lending out money to other commercial banks, right? That's what the repo rate is in this case. Well, the other day, on the 16th, we saw this massive spike. Now, to be fair, one thing that the media is not focusing on, and again, to kind of calm a little bit of the fears here, we have seen spikes like this before in the repo rate. We had one back in December of 2018, but this was the largest spike we've seen in 11 years, since 2008. So why did we see a spike in the repo rate? And what does this really mean? Well, we don't know exactly why we saw a spike in the repo rate. I can't answer that question for you. What I can tell you, though, is that when the rate increases, this means that there is a risk or an uncertainty in the repo market. Similar to how, for example, if I'm lending money to you and I know that you're a good creditworthy person, I'm only going to charge you maybe 1 or 2%. But if you're a risky client, if you have bad credit, then I might charge you 5, 10, 15%. And that's the exact same principle that comes here when banks are lending to one another. It meant that there was a bad apple, someone who needed either a lot of money or that there was a systematic risk that people were not going to lend to one another, right? So there was a really high demand for cash and people who probably weren't willing to give it at the time, or at least be able to satisfy that demand in repo markets. So when we take that into mind here, why is this concerning, right? Well, we obviously want rates and repo markets to be steady. We want there to be a trust basis between, banks who are lending to one another. This is a very integral part of the financial system. And in fact, in 2008, when there was a standstill in repo markets because no one was lending to one another because they started to hear rumors that there was something going on, there was something fishy, someone or many partners were insolvent. And when they didn't know who it was, everyone's sitting there in like a Western showdown, like which one of you is insolvent, right? And lending stops. And that was actually really one of the key reasons the financial system collapsed, because credit stopped circulating. And it takes a long time to recover from something that dramatic. Well, here's the relevant news here. A lot of the news is talking about the Federal Reserve cutting its base interest rate for the Fed funds rate. The interesting thing that's gone on behind the scenes here and came up spontaneously and no one expected was that the Fed injected around $75 billion into the repo market. So whereas the repo market is usually commercial banks borrowing and lending money for one another in very short periods of time, the Fed has decided to do a reverse repo, in this case, a reverse repurchase agreement. And they're basically, what they're doing in this case is serving as what a commercial bank would do on the lending side. Instead, though, they're injecting new money. Overnight, the New York Fed printed $75 billion. $75 billion in new money into the system. They have now increased the liquidity into the repo system, and they satisfied a lot of banks who needed this capital in the short term. Now, did the banks have to exchange something? Yes, they did. Just like with quantitative easing, which we'll talk about in just a moment, they had to put up some form of asset, some collateral. And predominantly, it is told, we don't know about this just yet, at least I haven't been able to find the data. If you guys have been able to find it, definitely feel free to share it down below. Supposedly, they have exchanged treasuries predominantly or other high-tier securities. And the idea here is that it's going to be in the short term, that the Fed will eventually get its cash back and will exchange the assets back when that cash is received at the Fed. That's the idea here. But there's a few things we don't know. We don't know if this is going to be short term. We don't know what assets they exchange at the Fed. Again, of course, according to what I have at the moment. So is this just another form of quantitative easing? Well, there's no doubt it is, in a sense, whether it's short term or as big as the previous rounds of quantitative easing, this is some form of economic stimulus. It's stimulating and providing liquidity to the repo market so that banks can continue to have more cash in the system and remain solvent, as that's the main purpose of repo markets. So it'd be very fair to make that claim. To dispel a lot of the fear here and to have a non-biased view and just really try to get an educated view of what's going on here, the important things to note is that this is a much less money than what we've seen in previous rounds of QE. This is not the kind of multi-hundred billion dollar to trillion dollar liquidity that the Fed injected and made very clear that they were holding for the long term. This is short term, at least as of now, and is collateralized, much like QE, but in much smaller amounts, to around $75 billion. So, again, we have a lot of unanswered questions here, and this could speak to a broader issue in the financial system if things like this can happen out of nowhere. If this isn't someone just needing a lot of cash in the short term for some other kind of reason, if it is for the need of protecting reserve ratios, this might speak to the fact that many players in the banking system are insolvent, that they may not be meeting to the required reserve ratios. You know, it's pretty crazy if you think about it. It used to be back in the day that the deposits that you put into a bank, right, the money you have in your savings account that the bank's making a ton of money off of, lending right back to you and everyone else in the form of credit, that used to be enough to meet the reserve ratio required for banks. But nowadays, it's not enough, right? They have to go to borrowing money from one another to meet their obligations in the short term. I think it speaks to a much broader issue. no matter if this speaks to insolvency of a certain bank in this case and the Fed having to step in, no matter if you want to see this as quantitative easing or not, this speaks to the fact that we haven't fixed the underlying issue. That over the last 11 years, since 2008, we have continued to stimulate the economy through false means, through quantitative easing, through lowering of interest rates to zero. And now we're getting ourselves in a basket of issues that are not only just weighing down average everyday people, but are going to come back to bite the banks in the butt. Sorry, I was a little bit of a trip up there on my words, but it's going to come back to bite the banks in the butt. And the reason it's going to is because we've got a lot of new little bubbles building up. We've got the negative yielding bond crisis, $17 trillion, probably heading up towards $18 trillion here soon, and is going to go even higher than that as the Fed has decided to cut rates. Because the U.S., if it keeps cutting rates like it is going to join the party. Everyone's going to become Japan. Everyone's going to have a negative yield on their bonds. It's going to be a race to the bottom to see just how far they can push negative yields and just how big they can balloon the bubble of negative yielding debt that no one's going to want when the Ponzi ends, right? And not to mention, that's coming at a time where we already have equities overinflated after a 10-year cycle, one of the greatest expansions in history. And in an environment where rates are literally negative in Europe and in Japan and a lot of other areas of the world, and borrowers are still not borrowing. Can you believe that kind of craziness? I think it speaks to the fact that maybe, just maybe, over the last 11 years, we actually haven't recovered the underlying economy, and that we've used the same dirty tricks and maybe new creative ways and labeled under different terminology in order to continue this same cycle that has led to a massive wealth divergence, a destruction of the middle class, and a destruction of the underlying economy, and disincentivizes actual real economic development and growth and investment. Well, I know I rambled on, and probably it's nothing more than just rambling, but you'll take it for what it is, and you have to determine whether or not I make any good points or not. So I really hope this isn't speaking to a broader issue. I know I'm hedging in a variety of assets, guys. It'd probably be beneficial for me, but I do feel the concern here because just like how in 2008, a lot of people were affected, I feel this time around, it's going to be even worse and it's going to affect people just as much as it did last time. And sadly, not everyone's hedging with crypto. Sadly, not everyone has some exposure to gold and silver or other forms of assets that can provide some form of protection. But sometimes things are inevitable. Anyways, that's it for the video, everyone. Again, I'm going to leave you linked to a ton of different resources. This article here from the Financial Times summarizes it very good, in my opinion. There's also a Bloomberg article. I've got an outline article here that you can read, even though they have the paywall and stuff after a few articles. Here's a good little documentation from Investopedia on repurchase agreements, and then also an explainer here as well from Reuters that talks about it. So you can get it from a variety of different sources, and I gotta say, they really do lay it out as it is in this case and talk about what we know at the moment. But anyways, that's going to be it for taking a look at repo markets. If you all found this topic as interesting as I did, definitely consider dropping a like. It's always appreciated. And as I mentioned as well, you can always check out the links down below in the description. But let's go ahead and dive into our sponsored review for Blackmoon. Alrighty, everyone. So let's go ahead and spend some time to take a look at today's sponsor, and it is no other than Blackmoon. Now, many of you may recall as far back as 2017, we originally talked about Blackmoon during the early days when it was doing its ICO, and it's come a long way since in achieving its goal of providing a clean experience on trading a variety of digital assets. But before we dive into what makes Blackmoon different, I want to go ahead and make a few things clear right off the bat. First off, they are regulated in the EU under VFA regulation of Malta, and they're audited by one of the major four auditing giants, in this case Deloitte, which is pretty active in the cryptocurrency space. Outside of that as well, it is a fiat on-ramp as well, so you can deposit euros into your account. And for those of you as well who trade over $100 worth of trading on your account, you're able to get over $20 of Blackmoon coin for free added to your account that you can utilize for trading or to simply hold. So again, there's a lot of cool stuff here right off the bat. Not to mention as well, they just did a recent UI overhaul. So we'll go ahead and dive right into it. And again, registration for an account is very simple. All you need to provide is an email as well as a country of residency. And once you do that and do a confirmation on your email, you can instantly log into your account. So this is what you'll see right here. You basically see what you would expect in exchange, a list of different cryptocurrencies that are available to trade. And again, we can scan through the different markets here, the different categories from Bitcoin to Ethereum, from Blackmoon coin coin, which as of now you're paying 0 fees. Eventually it'll go to 50% fees off on trading pairs on the standard market rates, which we'll talk a little bit about when we take a look at the fee structure. And you also have Euro and TUSD markets, so you can trade against technically, true USD in this case to get a dollar exposure. So everything here is pretty much as expected in the sense the exchange is very clean. We're going to go ahead and jump over to the exchange here on the sidebar. I've already got it open up here in a window. And what's really interesting is they actually have a custom build in the sense of their user experience for their trading application. And it's actually quite nice. I honestly think it's kind of nice to see an exchange stepping out of using just kind of trading view, but it has all the standard functionality that you'd expect. You can access all of the major indicators that you used to here. You can switch between a candle to a variety of other different types of charts to a line chart. And you can also use things like the Fibonacci retracement, trend lines, channels, everything that you used to setting, as well as different order types on the market. And we can go from our sidebar here and scan the different pairs that are available, see how much liquidity there is or volume on the market, and again, start trading directly from within our account. So I gotta say everything looks pretty clean here. A nice thing to note as well is their fees are actually quite competitive to other players on the market. They've got a 0.1% maker fee in this case, so if you're providing liquidity on the order book as a bidder and ask, and then also only 0.2% for takers. So really not bad compared to most cryptocurrency exchanges. And again, with BMC as well or Blackmoon coin, you'll get 0 trading fees up until the 30th of September this year, and then it's a 50% discount after that. So again, if you register for an account, you get $20 worth free of the coin. Now, there's a few things to note here as well. As I mentioned, Blackmoon has been around since 2017, and Oleg Sidak was a really interesting kind of founder of the team here because you need people, again, who are pushing the boundaries of trying to bring access to digital assets. You need people who have experience working in fields, not only predominantly in finance, but in this case, working in, again, raising capital and this new kind of field of STOs and things of that sort. Well, Oleg has a past of working at a company called Flint Capital, where they've done a variety of different VC deals. So he's worked in the startup environment before, and they've actually had 4 exits under their Flint Capital company. So it's actually really interesting to see that he's worked at something like this before. And I think that kind of knowledge really transpires into a much more successful company, having experienced stuff in the past in relation to raising capital and, creating startups. Now, one thing to note as well, and this kind of speaks again to what Blackmoon is all about in the sense of pushing boundaries and trying to produce new financial products or bring financial access to different types of assets. Blackmoon has recently partnered with Gramvault, which is a custodial partner based out of Switzerland that is actually going to help, in this case, to allow Blackmoon to be one of the first exchanges to provide traders exposure to the Telegram token in this case, or the Telegram Open Network token, usually known as TON. So you'll be able to access Gram tokens in this case from Blackmoon. So it's pretty exciting. And again, this is going to be coming out soon. So if you sign up for an account and stuff, you can stay up to date and stuff and check out with what's going on for Blackmoon. But again, I have to say here, overall, the user experience is really clean. And I got to say that the team has come a long way over the last few years since we last checked in on them. But again, if you guys would like to check out, click on the link down below and get your free $20 worth of Blackmoon coins and register an account today. It's quite simple. Anyways, that's it for the video, everyone. Thank you all so much for watching, and I'll see you all in the next one. Stay tuned.